Here's a mystery every business faces at the end of the month. You open your own accounting records and your cash account says you have one number. Then the bank statement arrives and the bank says you have a completely different number. Neither of you is lying and neither of you made a mistake, yet the two numbers don't match. So who's right? The unsettling answer is both of you at the same time. Tonight we solve that mystery with one of the most important tools in all of accounting, the bank reconciliation, where we take the bank's version and your version, adjust each one for what the other hasn't seen yet, and land on the single true amount of cash you really own. By the end, you'll reconcile any account down to the exact dollar. Let's find the truth. First, the bank statement, the monthly report the bank mails you. It lists every transaction, the date, a short explanation, your withdrawals in one column, your deposits in another, and a running balance. But here's the twist that confuses everyone. So, write it down. The bank keeps its books backwards from you. To you, cash is an asset, money you own. To the bank, your deposit is a liability, money the bank owes back to you. So when you deposit cash, you debit your cash, but the bank credits your account. Your withdrawal, you credit. The bank debits. Everything is mirror flipped. That single fact is why the statement can feel upside down. The bank is describing what it owes you, not what you own. So at month end, we have two cash balances staring at each other. On one side, the balance per the bank statement, what the bank thinks you have. On the other, the balance per your books, your own cash ledger, what you think you have. And they almost never match on the first look. Picture the bank saying $69,000 while your own books say $57,000, a $12,000 gap. That gap isn't fraud, and it isn't a blunder. It's just timing. Each side has seen things the other hasn't yet. Our job is to walk both balances toward the middle until they meet at the one true number. Here's the whole reconciliation in one shape. We build two sections. Section 1 starts from the balance per the bank statement and applies its adjustments. Section 2 starts from the balance per your books and applies its adjustments. Each side gets pushed up or down by the things it hasn't recorded yet, and when we're done, both sections land on the exact same number. That matching number is the prize, the true correct cash balance, also called the adjusted balance. If the two sides don't meet, something's wrong and you hunt for it. The reconciliation isn't done until adjusted bank equals adjusted books. Why do the two balances drift apart in the first place? Two reasons and only two. Reason 1, time lags. One side recorded something the other simply hasn't gotten to yet. You wrote a deposit in your books today, but it won't hit the bank until tomorrow. The bank collected a note for you this morning, but you won't know until the statement arrives. Same events, different timing. Reason 2. Errors. Somebody, the bank, or the company recorded a wrong amount, and any error you discover gets added to or subtracted from whichever side made the mistake. Time lags and errors. Every single reconciling item is one of these two. Let's meet the time lags on the bank side first. The first bank side item, deposits in transit. Picture this. On the last day of the month, you drop a deposit in the night slot after the bank closed. You recorded it in your books that day, so your books already count it. But the bank won't process it until the next business day, so it's not on the statement yet. The money is real and it's yours. The bank just hasn't caught up. So on the reconciliation, we add deposits in transit to the bank side, pushing the bank's balance up to include cash it hasn't recorded yet. Recorded by you, not yet by the bank. Add it to the bank. The second bank side item, outstanding checks. You wrote a check to a supplier and recorded it in your books the moment you mailed it, so your books already subtracted it. But the supplier hasn't cashed it yet, so the bank hasn't paid it. The bank's balance is still too high by that amount. So on the reconciliation, we subtract outstanding checks from the bank side, bringing the bank's balance down to reflect money that's as good as gone, deducted by you, not yet by the bank. Subtract it from the bank. Add the deposits in transit, subtract the outstanding checks, and you've got the adjusted bank balance. Now the book side, things the bank did that you haven't recorded yet. First, collections. Your bank can collect money on your behalf and drop it straight into your account, a note receivable it collected for you, plus the interest that note earned. You had no idea until the statement showed up, so your books are too low. We add those collections to the book side. One catch, the bank charges a small collection fee for the service, so it's the note plus the interest minus the collection fee, net. Recorded by the bank, not yet by you. Add the net collection to your books. Also on the book side, the things that make your balance too high. The money the bank quietly took out that you didn't know about. First, bank fees, service charges and penalties, the cost of printing checks, the monthly plan fee, e-transfer charges. Second, and this is a big exam favorite, NSF checks. NSF means not sufficient funds. A customer paid you with a check, you deposited it, and added it to your books, but the customer's account was empty. The bank bounces that check, marks it NSF, and quietly pulls the money right back out of your account. So you have to subtract it. That customer still owes you. Fees and NSF checks come out of the book side, and any company error gets fixed here too. Let's put the whole format on one screen. Copy this template. It's the one you'll use forever. Left column, balance per bank. Start with the statement balance. Add deposits in transit. Subtract outstanding checks. Plus or minus any bank errors. Equals the adjusted bank balance. Right column, balance per books. Start with your ledger balance. Add the bank's collections. Subtract the service charges and NSF checks, plus or minus any company errors, equals the adjusted book balance. The magic check. Those two adjusted balances must be equal. If they are, you found the truth. And remember, only the book side gets journal entries, because those are the items you hadn't recorded yet. Let's reconcile a real one. Grab your paper and fill in both columns with me. Riverbend Design's records at March 31st. Balance per bank, $8,400. Balance per books, $8,430. The reconciling items: deposits in transit, $1,200. Outstanding checks, $980. The bank collected a note of $600 plus $40 of interest, charged a $10 fee, a bank service charge of $30, and an NSF check from a customer of $410. Bank side first, $8,400, plus deposits in transit $1,200, minus outstanding checks $980. That's $8,620. Hold that number. Now the book side, built the same way as a schedule. Start at $8,430. Add the net collection, $600 note plus $40, interest minus the $10 fee is $630. That lifts us to $9,060. Subtract the service charge of $30 and the NSF check of $410, and you land on $8,620. And look, $8,620 on the bank side, $8,620 on the book side. They tie. That's the true cash balance. Now here's the key rule. Only the book side items become journal entries, because those are the ones you hadn't recorded yet. Let's do the first and trickiest one, the collection. Debit cash, $630 for the net that hit your account. Debit collection fee, expense $10 for the fee. Credit notes, receivable $600 because the note is now collected. And credit interest revenue $40 for the interest you earned. Debits of $640 equal credits of $640. It balances. That's entry 1. 2 more book side entries are coming. The service charges, then the NSF check, and we'll take each on its own. 1 entry down, 2 to go. On the last slide, we booked the first one, the collection, clearing that note off notes receivable. Now the 2 that are left, and honestly, these are the easy ones. First up, the bank's own service charges. Every month the bank quietly dings you, printing your checks, the monthly account fee, e-transfer charges, the odd penalty, and this month it came to $30. The bank has already taken it, so all we do is record the cost. It's an expense, plain and simple. Debit bank charges expense $30, credit cash $30. Debit the expense, credit cash. That's 2 down, 1 to go. And here's the last one. The entry every exam loves to test, the NSF check. NSF stands for not sufficient funds. Your customer paid you with a check, you deposited it, but it bounced, so the bank reached right back into your account and took that money out. Now here's the trap nearly everyone falls into. They book it as an expense. It is not an expense. You didn't lose the money. Your customer still owes you every cent. So instead of an expense, you put the amount right back where it belongs, as a receivable. Debit accounts receivable, $410. Credit cash, $410. Debit accounts receivable, credit cash. Lock that one in, it shows up again and again. And that's all 3 bookside entries booked. Your turn. Pause and reconcile it fully. Copperline Studio, April 30th. Balance per bank, 5,200. Balance per books, 5,180. Deposits in transit, 750. Outstanding checks, 610. The bank collected a $500 note with $30 of interest, minus a $10 collection fee, so 520 net landed in the account, a service charge of 20, and an NSF check of 340. Find both adjusted balances and prove they tie. Go, then hit play. Here's the answer. Bank side, 5,200 plus 750 minus 610 equals 5,340. Book side, 5,180 plus the net collection of 520 minus the 20 service charge minus the NSF 340 equals 5,340. Both land on 5,340. They tie. Nailed it? You can reconcile any account now. And here's the payoff. Let's book the quiz's 3 entries, all in one schedule. First, the collection, and this one is compound because there's a fee. 520 net landed in the account, so debit cash 520. The bank kept a $10 collection fee, so debit collection fee expense 10, right under cash. Then credit notes receivable 500 because the note is now collected, and credit interest revenue 30 for the interest earned. Debits of 530, credits of 530, balanced. Second, the NSF check that bounced. Debit accounts receivable 340 because that customer still owes you, and credit cash 340. And third, the service charge. Debit bank charges expense 20, credit cash 20. 3 entries and everyone is a book side item. The bank side never gets an entry. Screenshot this. The whole reconciliation on one card. Bank side, start with the bank statement balance, add deposits in transit, subtract outstanding checks plus or minus bank errors, equals adjusted balance. Book side, start with your ledger balance, add bank collections, notes, and interest, net of the fee, subtract service charges and NSF checks, plus or minus company errors, equals adjusted balance. The sacred check, adjusted bank must equal adjusted books. And the one rule people forget, only the book side gets journal entries because those are the items you hadn't recorded. Pause, screenshot, keep it for the exam. And that's bank reconciliation. You can start from 2 balances that disagree, adjust each side for what it hadn't seen, tie them to the exact same true number, and book the entries. Let me tell you something from my teaching days. This is the single skill new accountants use most in their first real job. And every year, a former student messages me that reconciling the company's bank account in week 1 was the moment they finally felt like a real accountant. That's you, soon. And here's what I want you to hear. Softly, you're not just watching a video, you're becoming the person who signs the audit, who runs the books, who runs the company, and it starts here, with 2 columns and the decision to keep showing up. If a step lost you, tell me exactly where in the comments. I read and reply to every single one, and there are no dumb questions in this classroom. Hit like and subscribe, follow on X at Applied Analyst, and grab the free exercises and full notes at appliedanalyst.com. No email wall. Next up, part 3, what actually counts as cash and cash equivalents, the last piece of the cash puzzle. I'll see you in the next class.